Will peak a stinking boo. Look at that. This is the VIX daily chart. The recent warning signs we have on the VIX have been dismissed. And the herd influencers on social media telling us, oh, this bar right here, that's telling us the bull market's just going to continue on now. And that was with our sell-off. Trump announced 100% tariffs on China. And again, it looks like that's going to be avoided with their meeting this week and possibly a deal that has been hammered out. We'll be watching that. But again, I told you to be watching the 50-period moving average, and we dropped below it. Now we're getting, look at that. Look at that. We're getting little narrow range body. This little tiny, little doji spinning top looking candlestick. If you get a wide range bar tomorrow and get back above the 50-period moving average, again, we could get a 9 count on the S&P and the NASDAQ, but it may not be the high of the count if we start to turn. Again, be watching for a push back above the 50-period moving average as we're still above zero on the MACD. We've turned down here. You're likely going to see this firm back up. Maybe we go a little higher with the 9 count on the S&P 500. Are slamming into some resistance here. Seeing in this video, be watching the VIX. People are dismissing the VIX. Somebody tell me, oh, the VIX is broken. No longer relevant. It's the kind of things that people say at tops. This time is different. Look what happened back over here when we had this first wave of volatility right over here. We had this volatility and we pulled back below that 50-period moving average. Eventually, we surged above it, forming a bullish falling wedge. And right now, looks like you're forming another bullish falling wedge. To me, that's what it looks like. You got a little bullish falling wedge right there. Very similar. And again, here we had the surge. Well, we had a surge over here above the zero line on the MACD, and we dropped back below it, and then you turn back above it, and that's when the big volatility happened. Here we'll likely firm up around it, but this was followed, after we dropped below the 50, this was followed by two big surges in volatility that ended up giving the S&P a 20% decline, 21% decline. As you can see down over here, this is the S&P down here, and the first surge was this first leg down, the second surge was the second leg down, and you ended up dropping 21%. Here we're in positive territory. We've had pretty mild pullbacks, likely going to get a reversal, but you're probably going to see something similar where we had a surge in volatility, a pullback below the 50, a surge in volatility, a pullback to the 50, and then another surge in volatility. Here it was a pullback to the 50 and the 200. But again, right here, we got above the 200, dropped back to just below the 50. You're probably going to see, and we're hitting this trend line, I believe, by the way. It looks like it. Yeah, we're hitting that trend line right there. And again, you're probably going to see another surge in volatility back above the 50 and surging above the 200. And like I said, again, nobody thinks it's possible now that there's any risk of any kind of volatility, any kind of sell-off. And I told you, you're going to see the reversal starts. Reversal bar, it didn't get confirmed on the S&P, but when we have a confirmed reversal, see a wrecking ball taken to the market, what took several months for it to go up from the April low, you're going to quickly come back down. The stairs on the way up, you're going to take the elevator back down, back towards the April lows. S&P is likely going to form that massive head and shoulders pattern. Please support the channel with the link directly below. That allows me to be able to provide you this information. Follow the link below to take you to a secured site, and you can donate any amount you want. I thank you for your consideration for that. For the divergence to complete this week, likely with the Fed, before or with or shortly after the Fed, in a good shot, you're going to get a peak associated with the Fed like we had in 2007. The stochastic will likely roll back over. You complete the triple divergence here in the more recent price action and the larger divergence going back to July. You'll close below the upper Bollinger Band at some point, in all likelihood, this week. The MACD will eventually roll over. By the time the MACD rolls over, you'll probably be seeing a pretty good sell-off. Stochastic rolls over, it will likely be starting, rolling over and dropping back below 80. That's true for the NASDAQ. It's forming a triple divergence going back here to September. And we tagged that upper Bollinger Band. We pushed to a new high there on Friday, and then we gapped higher today. So you want to be watching this gap to be filled. And then again, you've got that possible head and shoulders. If we start dropping and reversing, you can get the right side of the head formation or go higher, maybe get a topping tail or something if the bar 9 is the top, or if it's not, a lower high and the bar 8 is the top. If we get something like an inside day, a bearish inside day or something like that, and then we'll be watching for the close back below the upper band, Bollinger Band here in the daily time frame. You're going higher, the RSI and the MACD are not, multiple point diversions. Like the S&P 500, if I take the trend line back further, it did not touch these peaks right here. We had a little divergence here that gave us the sell-off on October 10th. But if you go back to the July peak, there's a divergence. We ended up getting a little bit of a pullback, but that trend line is where we're coming into contact with here. We're just slightly under it right now. So just something we're paying attention to there. Again, a possible larger rising wedge. A massive rally. That's what happens with blow-off tops. Signals have reverted back to bullish. They had started to turn bearish with this downturn right here, but it was not confirmed. Now signals are back to bullish. Last week and then late last week on Friday, the signals turned bearish for the S&P 500 or bullish for the S&P 500 and for the NASDAQ. NASDAQ still has this broadening formation. It's getting an overthrow move. It overthrew it slightly there on Friday and now above it. Now, if we look at the NASDAQ weekly chart, if we exclude the shadow here and connect it to these other peaks right here, we're still overthrowing it here in the weekly time frame, and that's okay. So patterns get overthrow moves, especially rising wedges. Broadening formations can do it too. I think you'll see the NASDAQ collapse back to the 200-week moving average down here, back to test this low as the S&P sets up a potential head and shoulders. You've got this broadening formation on the NASDAQ 100. The weekend, if we bring up the channel from the low in 2018 and the low in 2020, you draw a parallel boundary with this level up here. If you exclude the shadow, we were just under it with Friday's low, and now we're slamming up into it. If you include the shadow, we could go just a little bit higher and maybe get that 9 count in the daily time frame. But right here, if you exclude the little shadow right there from the 2021 high, you're slamming right into this. Include it, it's a little bit higher, but you've got a really nice looking parallel boundary. You're likely going to turn here or a little bit higher, including the shadow, one or the other. We are overthrowing the upper boundary of the broadening formation. That's fine. That's allowed. It doesn't negate the pattern. You still have a broadening formation. Even if I take it a little bit above the peak there in December of 2024, you still have a broadening formation. It doesn't negate the pattern. Again, you're likely going to see a collapse back to the 200-week moving average. Again, probably some kind of partial rise there. That'll allow the S&P to get a right shoulder for a head and shoulders, and then you'll probably see a break of the channel here, and eventually come back to test the pandemic low and the 2018 low, which is the support zone, and that's going to be, in all likelihood, just above that area or just below that area, below the pandemic low, is likely going to be where the bear market ends. Now, if we do what we did with the bursting of the tech bubble, an 80% drop, you're coming down and you're taking out those lows. Okay, you're taking out the low from the pandemic, you're taking out the low from 2018, and again, NASDAQ's probably going to drop 70 to 80%, maybe more. Bursting of the tech bubble, it dropped 83%. If we drop 80% or more, you're going to be taking out the low from 2018 and the low from 2020, the pandemic sell-off. Keep that in mind. 80% sell-off takes the NASDAQ back into the 5,000 area. No, this time's different. This is the AI bubble. It's different. What they said with the tech bubble. Oh no, that's not going to happen. At the bursting of the bubble. That was and everybody goes, oh, that was a bubble. That was different. The bubble right now in the stock market is bigger than the bubble back then. We have the biggest bubble in history. You don't understand. The bear market ended over here. We're in a new bull market. We're going into the 4th year of the bull market, and that's going to be good. That was not a bear market. That was a crash. like over here and over here, a crash in the long-term bull market. The bull market started back in 2009 and it hasn't ended. The people that call this a bear market are the people that said it was never going to happen. Just be aware of the channel and be aware of the possibility of a broadening formation and the possibility of a 70 or 80% drop on the NASDAQ going into late 2026 or on into 2027 somewhere, maybe the first half of 2027. Bitcoin has already topped NASDAQ and S&P in 2021. NASDAQ topped shortly after Bitcoin, and then the S&P after that. NASDAQ or S&P is NASDAQ Junior now because of the Wall Street darlings, the tech stocks on it. So they're probably going to peak closer together this time. A shot of it in early October, a shot of it this week at these resistance levels that I'm talking about. Bitcoin has already topped. It's setting up a counter trend right now for a lower high. Will likely complete it surrounding the Fed and then begin to sell off as Bitcoin did the last Fed meeting. Aware, a good shot we're going to sell off with the Fed this week. Again, including the shadow, we're coming right up to that level. Over here we had a 37% sell-off, over a 37% sell-off. I think it was 37.5% or so. If we get something similar to that, you're coming down here to the lower boundary of the broadening formation. A 34.5% drop to the 200-week moving average. If we go down to the lower boundary here, then you're looking at a greater than 40% drop, depending on where we reach it and how long it takes. Again, it just depends on where you reach that trend line if you do end up going back there. 80% drop is that high 5,000 area or rounding up to 5,100. That's something to pay attention to. The market rallying on a potential trade deal truce, as was announced over the weekend. The Dow was up 337 points. The Dow was up 0.71%. The S&P was up 1.23%, up 83 points. NASDAQ up 1.86%. The Russell up 0.28%. The VIX was down 3.54% to close at 15.79. A deal has been hammered out as President Trump and President Xi are to meet on Thursday. Again, could avoid the tariffs, additional 100% tariffs that would take the tariffs to 150% on China if this is agreed upon. They do have the framework, as the Treasury Secretary has said. A big week this week. We've got big earnings. We've got the Fed. We've got this meeting coming up between the two presidents on Thursday. So a lot of things to digest. We've got triple bearish divergences forming. The S&P opened up and it slammed up into the trend line from these previous highs. Overthrew that a little bit. You can see here with momentum, and we've got it on the RSI and other indicators. We've got these divergences, these triple divergences in the most recent price action. Now, what trend line we are slamming into is if we go further back. Now, the trend line I just showed you is connecting these more recent highs right here, and we've overthrown that slightly, but we're slamming into this trend line right here in the daily time frame, going back further, and we're back testing the trend line from the April low originally that we broke, but it failed to be confirmed. That break on October 10th, we never confirmed that candlestick to the break of the trend line, neither the trend line on the break of the May trend line from the May lows going back over here, that other trend line I show you. Neither break of those trend lines were confirmed with this October 10th candlestick. We've gone back up. And again, now you're hitting this trend line from these previous highs right here, going a little bit further back, and you're slamming into that. You still have a rising wedge, and you're forming another reference point of a divergence. And I'll just draw it in here, extend it out, because again, it looks like it might be wrapping up here. And as you're hitting this trend line right here in the daily time frame, again, you're slamming into that weekly trend line that excludes the shadow from the wick there from the 2022 low. So again, this is a trend line of interest here. Again, in the more recent price action, you're forming a divergence with these previous highs, and then it goes even further back because of the extreme reach over here and these lower highs that are setting up. So you have this massive divergence going all the way back into the summer here, back into the July 31st peak. Just a trend line to be paying attention to. If we just zoom out here a little bit, you can see we're likely forming a massive head and shoulders pattern. Again, I expect that you're going to likely see a sell-off with the Fed as we did in 2007. So as I said last week, you got a good chance, as we broke to new highs last week, I said you have a good chance of either that we peaked on Friday or you're going to peak this week with the Fed. Got a similar divergence back over here at the February peak. Again, I think you're forming a massive head and shoulders. I think you have a massive broadening formation on the NASDAQ and Nvidia, and I expect you're going down to the April low. So I think you're going to get a 20% drop over the next 10 to 14 weeks, and that would put us into January somewhere where I think you're going to get the emergency cuts. And all likely, it might happen in December, but I think it's more likely to happen in January. These tops, again, as I talked about over the weekend, you've seen, 10, 14 weeks in 2007 before you got a sustainable short-term bottom. So I think this is likely what's happening. I think you're going to sell off into January once we peak, and I think you got a really good shot that we see a peak this week with the Fed. Historically, that's the way it played out in 2007. The Fed began cutting, the market topped. Now we've gone longer. Back then the market peaked 17 days later. We've gone longer than the first rate cut there on September 17th of 2025. Still likely to be similar, and you're forming again these multiple point divergences here on the RSI, the MACD as well. It turned back up. You have the MACD making a lower high, prices still making a higher high. You've got massive multiple divergences developing. And when you have multiple divergences developing, it's a reversal that's going to happen. It's not going to be a pullback in all likelihood. So again, we're likely in that topping process. And again, the stochastic reaching extremes. Yet again, I think you're going to see the stochastic roll over with the Fed like we have seen from time to time. Sometimes the Fed marks a bottom, massively selling off. Other times the Fed marks a continuation of the trend, and then when you get a massive rally, the Fed often will mark a top. The 2007 scenario suggests that's likely going to be the way it plays out this time. As we're pushing up into this trend line from these previous highs, from the July peak, really. You can actually take it all the way back to the summer. With that move, the S&P gapped above the Bollinger Band, the upper Bollinger Band. We were just tagging it there on Friday, but we did have a gap. So now you have two gaps that are likely going to end up getting filled. The 10 period had crossed below the 20 period moving average, but with our gap higher there, turning back up above it. We'll likely see it close below the upper band this week and mark a reversal. But as you're gapping higher, as you're slamming up into this trend line from these previous highs in the daily time frame, we're slamming into this trend line. Now, previously, again, I told you if we include the shadow here from the 2025 April low, you were already hitting it. And I told you my previous channel excluded the shadow over here like you see right now and excluded that area, which is where we're hitting right now in the weekly time frame. Once we began to turn off our previous October 9th high, again, it made a very nice parallel channel, including this low. So again, the one thing about these shadows, these wicks, you never know if the channels will include them or exclude them, and I've seen both on many, many occasions. Our trend line here has not changed, though. It's just excluding the shadow or including the shadow. Here, rather than taking it from the 2020 low to the 2025 low, which I had done with our previous October 9th high, again, now I'm excluding the shadow here, going back to what I had previously, the 2020 low connected to the 2023 low, excluding the shadow slightly there, excluding the shadow here in April of 2025, and that's where we're going to right now. So again, that's why I told you with the October 9th I told you it could be the top if we confirmed the breakdown with that reversal bar on October 10th, but we never confirmed that bar. And I told you if we don't, there's more wiggle room to go higher. This is the wiggle room to go higher in this upper boundary of the channel. Still back testing this trend line from the 2023 low. This is the weekly chart of the S&P, and we're slightly overthrowing that trend line from the 2023 low, and we're coming up here and slamming into the upper boundary of the red trend line here. Last week we completed, this is the weekly chart. Last week we completed a 13. Now you have a 9 followed by a 13. Remember I talked about this 13 count that was still in play here. It's now completed with last week's weekly bar. Now we start this week, and again with the 9 and the 13, that is a reversal pattern. We had a 9-9 signal. You got a reversal bar, but it wasn't confirmed, and now that's evolved into a 9-13. And again, this is just showing complete price exhaustion. And again, at some point, you're probably going to get a really ugly drop. Great Scott, did you hear what I said? I said, again, once the divergence is done in the daily time frame, it begins to play out here in the weekly time frame. We start seeing the stochastic rollover in the weekly time frame. You're likely going to get a pretty ugly drop. I am of the opinion that we're going to get a bigger decline than what we had over here, which was 21%. I think you're going to drop down about 30% or so down to the April low. I think you've got a massive head and shoulders, as I showed you on that daily chart. Just be aware that we have the 9, 13. We're going a little bit higher with the 9. Now you get the 13, and we're going a little bit higher again. I think you've got a really good shot now that the Fed is. This is the hint. This is the clue that we're likely leading a topping process, and it's going to be kicking off the bear market once we start getting this dramatic drop. Recession is coming, and the Fed is about to do jumbo cuts. But the fact that the Fed started cutting in September is a huge red flag. It's a huge warning sign. It's a huge clue. Slamming up into these resistance levels. And yes, I know we went a little bit higher, and we still may go a little bit higher, but it's not going to last. So just be aware of that. 13 count into these resistance levels. This is the weekly chart here. But just watch to see, do we get a reversal? Now, even if we get this deal agreed upon, again, it could be a sell the news event. It's already priced in, just as the Fed rate cut already priced in. Going to get some big earnings. We'll be watching that. Also, the tensions here going on between the U.S. and Venezuela. Again, looks like the U.S. is going to go, they have ships moving out there. The U.S. is dealing with the cartels, and the government there is involved in it. Looks like there's going to be something on land. I don't know if anything becomes of that. Sometimes geopolitical issues rattle markets. Other times they don't. Who knows? So far, that's not been an issue, but it's just something to pay attention to. Who knows? Also, these sanctions that are now targeting Russia, something we're paying attention to. So the sour loans with the banks, eventually that's going to come back at the news and rattle the market. So pay attention to that. I think, let me just say, Powell's going to come off very concerned about the economy. Got a legacy to protect, and he is so far behind on rate cuts. That's why I believe that in December or January, you're going to get the jumbo cuts, probably in January, but it could be as soon as December. We start seeing markets collapse. I think you're going to see, again, a 27, 28, 29, 30% collapse. I think it'll be bigger than the last collapse. Powell is going to get or express a lot of concern about the economy. Again, when we see government reopened, there is a good chance that we see a negative number with the job creation. That was associated with the 2007 top, as I talked about. Flip over to the daily chart, and I want to say something else. We also have this government shutdown, and I told you back on October 14th, it's going to go on longer than everybody thinks. I think it could go on 5, 6 weeks, 8 weeks to 2 months or so, possibly longer, maybe 10 or 12 weeks going into 3 months. I think it's probably going to be 5 or 6 weeks, maybe 8. Right now we have the second longest government shutdown. Eventually, markets could start showing concern about that. Powell is likely going to express concerns about it. That's another reason why we're going to get the jumbo cuts, probably in December or January, more likely January, because again, usually it's what happens is you drop for 10 or 12 weeks or 10 to 14 weeks at these tops. 2000, we dropped 10 weeks, but the Fed didn't panic until the rally back up in the second drop after the lower highs had set up. But That dropped 40%. Eventually, we did get the jumbo cuts. I think you're going to see a significant drop, and I think the Fed will panic. I think that'll be by December, January, more likely January, because if we top out this week, 10 weeks going forward, you're into January, 10 or 14 weeks going forward. I think the government shutdown will last longer than everybody thinks. I think the government is purposely being shut down to try to create a recession ahead of the midterm elections. I think that's very likely. Eventually, I think that the government shutdown will cause the market to be concerned. I think Powell will show concerns about it probably this week in the press conference. I do want to say this. Each of these 13 and 9 counts have produced either a sideways correction or a pullback, a smaller pullback. We haven't gotten a reversal yet. Again, this is a daily chart. At the 9, you had the sell-off, the reversal bar that never got confirmed. We never closed below it. We've rallied back up. You got a 13. Now you're going higher. And now, right now, if I move my little arrow at the upper red trend line, you're getting bar 8 this week ahead of the Fed meeting. You close above the bar from 4 bars ago down here at bar 5, which you're likely going to do. You'll get a 9 count tomorrow, the head of the Fed meeting, the day ahead of the Fed meeting. 9 counts have been associated so far with pullbacks or sideways moves. 13 count, smaller pullback, that's all we've gotten so far. Again, at some point you're going to get a reversal and it's going to be pretty ugly. You're going to get a crash that's going to kick off the bear market, likely going to be greater than 20%. My guess is it's going to be about 27, 28, 29, 30% or so. The NASDAQ kicked off its bear market in 2000, it dropped 40% in 10 weeks. Could see something that ugly, possible. I think the S&P has a good shot at that head and shoulders if we go back to the April low, which would be about a 30% drop or so, give or take. Be aware that we have an 8 of a 9 on the S&P 500 going into the Fed meeting on Wednesday, going into the earnings. Again, I think you're going to get the cut out of the Fed. You're going to get a quarter point cut, but I think the Fed statement and Powell likely going to show concerns about the economy, likely show concerns about the government shutdown, and that could be the catalyst, possibly. Maybe it's something we don't know about yet. Again, 2007, you had the Fed meetings before you got the jumbo cuts, and each time after the initial starting of the rate cuts, which we've had in September now, each time they were associated with the sell-off, and I'll show you the chart in just a second. 8 of a 9 here on the S&P. I'll be watching this area. Will be, again, the 9 count does not have to be the high of the count either. It just has to be above the bar from 4 bars ago. So this bar 5, the close down here, as long as you don't close below that bar, you complete a 9 count tomorrow. You complete a 9 count tomorrow, then in the more recent price action here, you have a 913.9, which is a massive reversal signal. That's a powerful reversal signal. A 9.9 is a reversal, 9.13 is a reversal, but when you get a 9, fall by 13, fall by another 9, that's a 9.13.9. That is a massive reversal pattern in the more recent price action right here. We've got the 9.13 in the weekly time frame going a little higher. And here it is again in the weekly time frame. We had the possibility previously of a head and shoulders top over here with the left shoulder over here, the head formation, and possibly a right shoulder. That did not play out. You came up here to a new high. You had the possibility of a double top. That's not playing out. We're continuing to go higher. So now you have the possibility of a larger head and shoulders pattern. If we see a 9 count produce a reversal or be the topping bar or be a lower high, 8 or 9 has to be the high of the count for it to be a perfected signal. 8 bar is the high of the count, so it will be a perfected signal. And then you can possibly form a head and shoulders. No guarantee the pattern sets up, but again, just watch that to see if anything becomes of it. So far, the previous head and shoulders didn't play out, and the double top did not play out, but you're still at this resistance area and trying to overthrow it a bit. Again, we'll see by the end of the week, does a weekly bar turn off of this level? S&P daily right here. NASDAQ still has that 9.9 signal in the weekly time frame. Here in the daily time frame, you got an 8 of a 9. Previously, again, count on October 9th gave us a sell-off October 10th, down 3.5%, but there was no confirmation of the bar. Now you're forming a triple divergence on indicators, and again, you have this possible larger head and shoulders pattern. I don't know if it plays out, but again, if we come back to support and try to bounce. So again, we'll be watching what becomes of the 9 count for tomorrow. The 8 bar is the high of the count. You've got a massive gap today. You have a gap on Friday. You're going to come back and likely fill these gaps soon. But the 8 or 9 bar could be the high of the count. I'll be watching that triple divergence in the daily time frame to see starts to play out with the 9 count here in the daily time frame here on NASDAQ and on the S&P daily chart.